Welcome back here with the CNBC TV18 Diwali Masterclass, and it's time for the audience to take the center stage and really ask their questions. I think we have plenty coming in. I'll start with Shrenik Shah. Shrenik, can we see you? Okay, there you are. Welcome to the show. Go ahead, ask your question.
First of all, I'm very glad to be here. I wanted to ask, like passive as a strategy is very big worldwide, right? And in India, it's still gaining momentum. People are still trying to adjust to index funds and kind of just learning about them. I wanted to ask, what would be a good strategy? Would it be passives, only actives, or a mix of passive and active both in your portfolio?
Okay, I'll ask the panel. Interesting question for sure. And I think we got these queries during the course of the year as well, because a lot of fund houses have started now launching mutual funds which mirror the index itself, the mid-cap index or the small-cap index. So basically passives on even mid and small caps. Naren, what's your take on this trend and what would your advice be?
If you look today at anything other than mid-cap, you'll find that actually huge alpha has been created over the last 1 year, 3 years, even 5 years at this point of time. In mid-cap, it's quite a different experience. Mid-cap funds have done very badly against benchmarks. So passive has done very well. So you go through these phases. If you had looked at 2018 end or 2019, passive had beaten active very, very much in most of the large cap funds. So you go through these cycles, but at the same time, on a continuing basis, I think we have a tortoise in the form of passive, and we have to recognize that. And having said that, there will be times,
the race in the
but
end.
you should see today the performance of actives against passives in large cap. You will find that most of the, no one talks about it today, but most of the large cap funds and most of the flexi cap funds have done so well against the index over the last 1 year, 3 or 5 years by a huge margin. When they underperformed, people kept talking about it. But today, when they have outperformed, no one is talking about it. That is one of the regrets of an active manager like me.
Not at all. That's why we have you here, because we want to hear from you. And, when you put out some of these snippets, I'm sure people will keep it in mind and go back and
But truly in mid-cap, it's still, at this point of time in mid-cap, passives have beaten active hollow. But in all other categories, actually on the last 3 years and 5 years, actives have actually done pretty well.
Okay, I love this active-passive debate. It's an evergreen one, and at least in India, it is going to continue to be a vibrant one for many years ahead, right? Okay, so coming back to the classroom, Naren, let's get to your lecture. You are going to teach us a bit more about asset allocation today, right?
Yes.
Okay, so tell us, how should we look at asset allocation? Why is it important? And how should we go about, asset allocation as we get into this new year?
See, 2007, 8, 9 was a red letter period, where, as Nilesh pointed out, the number of investors in India in mutual fund is still very small. So we felt that, this mutual fund industry saw itself as an equity mutual fund industry. And we said that we have to move out of that and move into a situation where we created categories like balanced advantage and multi-asset. Because if the mutual fund industry was not a equity mutual fund industry, actually gold gave very big returns in 2008. And consequently, this whole thing, we started popularizing categories like balanced advantage, and later when scheme categorization came, categories like multi-asset. Because once we did that, we got the real benefit actually in COVID. Because in COVID, actually, equity did badly immediately, but asset classes like gold did well. And we have had a situation where this whole concept of asset allocation, where you invest in equity, debt and gold, actually leads you to a very good experience compared to just investing in equity. And the problem that Nilesh pointed out, that investors are much more invested in other things and not in mutual fund, can be corrected only in that way. Because the day you make it an equity mutual fund industry, you cannot make the industry as large. Look at the scale of all the other industries, they have been much bigger. So that's what we felt, and the experience of 2018 to 22, as the data would show, there are years in which equity has done well, there are years in which gold has done well, and then the investor experience is much better, and then you can scale up the industry. And today, all of us in the industry have launched multi-asset funds, primarily because we have realized that that is one way of increasing the number of investors in the industry, and ensuring that the investor experience can also be much better over the next 3 years, 5 years, 10 years.
Okay, absolutely. And I guess as that data was showing, it's very volatile, these three asset classes. When one does well, the other is usually languishing. So maybe a mixed approach works. And it's also tax friendly, right? I mean, the multi-asset
Yeah,
funds have the tax advantage.
that is less important than the fact that, you know, in a year like 2020 or a year like 2008, it is gold which gives you the return.
Yeah.
And in other years, it is equity which gives you the return. So it kinds of, because finally at the end of the day, the return that you get in other asset classes is low. But this balancing influence actually moderates the investor experience, but gives an investor a much better experience.
Okay, great. We have some more questions from the audience coming in. I think Yash Parekh, Yash, there you are. Welcome to the show. What's your question?
Thank you so much. First of all, great to be here. Thank you, Subi, for having us here. I have one question on style investing, that is growth versus value. So, I personally believe it is very cyclical in nature. For an example, between calendar year 17 to 19, growth outperformed value by around 20-25%. Between 20 to 22, value outperformed growth by around 10-15%. So, first of all, how to determine what are the parameters of when which style to adopt, and what are the parameters which helps you to decide when the cycles are changing. That will help us to, to make a better influence decision.
You know, I'm going to give this question to Mihir because his classroom lecture today actually is, relating to this subject. Mihir, you were going to tell us about this beast called valuation, how to look at it, how to befriend it. At times we want to forget about it when the market is running away. So I think it's a question that a lot of us grapple with. And as our friend here is asking, this has been the year of power stocks and capital goods stocks. I mean, these stocks never worked for decades. Absolutely. And now here we are.
Absolutely. So it's a very pertinent question at all points in time in the market, not only today. So I mean, philosophically, when you're talking about investing in stocks especially, it's a function of various parameters, and stocks and companies are impacted by so many variables. So as an investor, the only thing that is in our control is the price at which you enter or exit the stock, and that's where valuation comes into the picture, right? Because if you think the actual value of the stock should be much higher than what the current market price is, then you buy, and vice versa. If you think the actual value is should be below the current market price, you are a seller in the stock. So valuation, when you go about valuing a company, basically at the crux of it, you're trying to say this is the current book value of the company, and the company is likely to generate cash flows in the future. So let me calculate the value of those future cash flows. Typically, near-term cash flows are more predictable, more visible, and the far out cash flows are less predictable, less visible. So what we call the first 10 years, typically 5 to 10 years, is the visible or the forecast period, and beyond that is what we give a terminal value. Now, the terminal value also assumes a certain growth rate beyond the 10 years. What happens is that in high growth companies, if you look at the overall value of the when you calculate the overall valuation of the company, the value of the terminal value is dominant, and the value of the near-term cash flows is less dominant, and vice versa. In slower growth companies, typically the value of the near-term cash flows is higher. So what growth investors tend to do is they don't mind taking a far-out view. They would ascribe some significant value because they do expect the growth to continue for a longer period of time. So when you look at the value investor, they tend to give more importance to the visible, the tangible net worth, the tangible book value, and the near-term cash flows. That's where the difference in philosophy happens. In bull markets, people tend to be more optimistic. They want to see far out in the future, so maybe the growth investing style works better. In choppy markets, typically people are risk averse. They say, no, let me focus on the near term. I don't know what's going to happen in the future. So that's when typically the value style comes in the focus. So it's to some extent a function of the sentiment and the business cycle that we are in. So that's where the difference between growth and value comes in.
And personally, would you call yourself a growth stock picker or a value stock picker?
I'm personally a growth stock picker.
Okay.
Because we are in India, we are a growth market, and one of the things that you keep reading is that Indian market valuations are at a premium to global, so we are expensive. But the fact is that I looked at the data since 2006. India has traded at a premium to all other markets, including emerging markets and developed markets. And that's because India has always given higher growth in terms of GDP, in terms of corporate earnings. So valuation takes into account long-term growth, and India has delivered long-term growth which is superior to others, and so we've always traded at a premium. So that's where, the heart of a country, when it's its growth, I'm a growth investor for India.
Okay, got that. We have another question which kind of, ties into this theme. Naveen, I know you have a question on PSU stocks, right?
That's right, ma'am.
Yes, we can hear you.
So firstly, thank you for the opportunity for getting me here, and I can interact with the gurus of the stock market. So my question is that lately we've seen that PSU stocks are back in favor, and these represent both growth and value in one. So because of this, should retail investors now pay attention and have a portion of this of their equity portfolio? What percentage of such stocks should they keep? And is it that they play this through these ETF, CPSE ETF or the Bharat 22 ETF route rather than buying stocks directly? So could you throw some light on it, please?
Great question. I think it's a question that will resonate with a lot of our viewers, I mean, the audience here and the viewers on the channel. Naren, you want to take this one? First of all, PSU stocks, I want to ask Nilesh as well. Are they growth stocks or are they value stocks at the end of this year now?
I think it's tough to say. 3 years back, on every meeting we used to be asked, how can you own PSU stocks? It used to be such a difficult task to convince people that those PSU stocks were worthwhile. 3 years later, now the questions have changed substantially. So at the end of the day, they were deep value stocks 3 years back. And when they were deep value stocks, it was so easy for us to buy them. And today, when they are no longer deep value and today they are actually growth stocks, some of them have become from deep value to some of them are deep growth stocks. So frankly, it becomes a debate that there's no straightforward answer for anyone to be given, that because finally at the end of the day you have to look whether that deep growth is implied is too high or is it not. But 3 years back the debates same time was so different, and now it is so different.
Which is why I said, right, this has been an unexpected year, the year of the unexpected. Very quickly, 30 seconds before the break, but your take on PSUs. Are they growth? Are they value? Should they be bought, not bought? What's the advice?
They cover entire spectrum from value to growth at reasonable price to deep growth. There is oil marketing companies which are still valued today.
Exactly.
There are companies in banking and many other manufacturing PSUs which are at GARP. And there are some low floating stock PSUs which are there today only because floating stock is limited. The day divestment begin, prices will fall significantly from here.
So tread with caution. I think that explains it really well. Thanks to both of you. We'll take a very quick break. We come back on the other side and then we get to the heart of the conversation. Lots of questions on the mid-cap frenzy in the market, and I know our audience is looking to ask more. So back in just a moment.